Welcome to our Leaders in Housing Counseling call for this week, for these 2 weeks. We are completely, we have kind of a jam-packed agenda again today, so we're going to dive in very quickly. Looks like a lot more people are getting on, but that's fine. We're going to get started and roll out. Lots of initiatives out there, lots of things that we're struggling with. So part of the goal of this call, and especially the conversation about loss mitigation, is to hear from the field, that would be you guys, about what you think our best positions ought to be on some of these kind of tough questions where tough choices have to be made on loss mitigation. We're in the middle of a deep debate. We'll talk about it more in 15 minutes or so once we get through the rest of the agenda. But your experience, what you think the documentation levels should be, whether we should be focusing on, deep dive, deeper resolutions based on income, or help more people with streamlined, and are these actual trade-offs we're making, all that sort of stuff. We'll put it out on the table. We've got 2 experts in the field coming up, Julia Gordon, who has a long history in our work in the housing advocacy, and Ellie Pepper, who's a familiar voice on these calls from Empire Justice, but both of them have been deeply involved in these questions, and I know you've been involved in the practical side of it, and we really need to start figuring out some of this stuff, so we'll be relying on you. With that note, let's move quickly through the rest of the list of our topics here. So federal funding update. So Matthew, I guess you had a THUD subcommittee meeting today, right?
Well, so the subcommittee, the Senate THUD subcommittee moved the bill on Tuesday, and then it went to the full committee this morning, and it was passed unanimously. I have not been able to find a draft of the bill, so I unfortunately don't have a report on what the numbers are in that Senate bill. I do have some emails out, so if in the course of the call, if I get a response from somebody, then I'll give an update. But so all we can say for now is that the Senate Appropriations Committee, the bill's moved out of the Senate Appropriations Committee. On the House side, there's still hasn't been a budget approved. Friday was the deadline. This past Friday was the deadline. They could still theoretically do one, but I saw today that Speaker Ryan had made the comment that he just didn't have the votes to move a budget. But as on the Senate side, the House is still going ahead with their appropriations bills. They're both just using the numbers that they agreed to in the budget deal last year. The debate I've mentioned before is, the kind of hardline Freedom Caucus wants to go back to sequestration level funding levels. So that's all I have. If I don't in the course of the call get the numbers on for HUD Housing Counseling and NFMC, I'll follow up with an email as soon as we have those.
Good, minute-by-minute coverage here. Okay, so we had kind of an interesting breakthrough this last week. Housing counseling is part of presidential campaigns. So a month ago, Hillary Clinton's put out her housing policy, which had lots of good things in it, including a very good call for increasing support for housing counseling for pre-purchase counseling. And Bernie Sanders came out this past week with, again, a very aggressive housing policy, lots of good things in it, and calling for pre-purchase counseling and for foreclosure counseling as well. He actually tied it to NFMC, which, it's a logical idea on one level, but I'm not sure we'll be able to sustain the funding at NFMC. So, but the concepts are there, and that's exactly what we want. And Matthew put in here, both point to empirical evidence that counseling works, which was a nice gesture here. We're very pleased. So, and actually, just to recognize, one of the goals of NHRC had been to elevate the role of housing counseling and in policy circles and in the public. So we have not accomplished the public part. I'll admit, I'm the first to admit, we're not quite there yet. We're still thinking about some things, but we have a long way to go there. But in the policy realm, housing counseling is really becoming more and more part of what programs are designed and thought about. And this is a huge achievement, and you know, thanks to everybody's input, thanks to our continuing to elevate housing counseling in each discussion, all the sign-on letters, all the kind of face-to-face meetings that you do with your local congressional people, with people who fly into the meetings in DC. All of this matters deeply, and we are building a real presence. We'll continue doing this. Where I think this is very interesting and where my thinking is going is around what the oh, actually, one more before we go off. This is a nonpartisan call, so we did also look for the housing policies of the other candidates. That would be Trump, Kasich, and Cruz. And it doesn't appear that, as far as I can tell, please correct me if I'm wrong, Trump or Kasich have a housing policy that I could find. Cruz didn't actually have a housing policy, but he did have a provision that would be eliminating 5 cabinet positions and or departments, one of which would be HUD. So you got to think that's kind of a housing policy. So make of this what you will. The next big issue, so there'll be the presidential campaign, and you know, we'll do a couple little things to see if we can't get housing to continue to be an issue and housing counseling to be sort of as a positive piece of all these. It'll never be the focus of the debates, but the fact that we're on the list matters a lot. But interestingly enough, while there's all the stuff going on about the campaigns, in fact, the people who are likely to win are working also right now about what transition government might look like and how to line support up and you know, really have an administration that's ready to run on day one, January 20th. So in those transition conversations, we will want to be there as well. And one of the big kind of things that I'm thinking about is how we could really position home ownership as a key policy for the administration. And one of the lessons we've sort of learned out of the problems we had with Hawk getting defeated is that you need to really think about it as jobs and employment. So thinking about this in conjunction with some industry players, but really thinking about how we can get housing to be, home ownership to be a much more common event, especially in underserved communities. And one of the big issues, I think, is people often can't afford in many of the markets we work in. If you're lucky to be in the Midwest and in some parts of the South, that's not the case, and that's great. And some older industrial towns. But for a lot of cities, for a lot of urban areas, housing prices has really gotten out of whack. And so key to this might be some ambitious down payment program that helps get people in the door. So worth thinking about, and you know, we'll toy around with these ideas over the course of the summer, but we'll want to be well positioned, and we'll work on trying to bring in other progressive housing groups on these questions as well, so that we're not the only voice. We'll try to bring in. But the one great thing about our work over the last few years is that there is a lot of support among other housing advocates now for housing counseling these days, and you know, we're doing many of the right things, and you know, you're doing good work in the field, continuing to spread that good word as well. I mean, all of this fits together. So that's the a hopeful opportunity. Very pleased that we ended up being in the housing flanks for both Clinton and Sanders. So next up, Google AdWords. Do you want to say a word or two about that, Matthew? We're revitalizing this campaign.
Yeah, so it's been a few months at least since we initially brought it up, and had many other things happening, and are now just getting around to kind of launching this working group that we had talked about. The idea, just to kind of quickly recap, I mean, nonprofits are eligible for up to $10,000 a month in free AdWords. Our idea is to try to get a bunch of groups, ideally, if we had 15 or 20 different agencies doing it. So the idea is to sign up and start taking advantage of it, and just start doing some test campaigns and figuring out what works, and then trying to bring it to the broader housing counseling community, and see if we can utilize this free advertising as a way of kind of going to that piece Bruce was talking about earlier, the building the public knowledge of and recognition and of housing counseling. Someone just asked, yeah, it's up to $10,000 a month, and that's the number I have in my mind. I haven't looked in a while. Does that sound right to you, Bruce?
Yeah, that's right. That's right.
Okay.
Yeah.
So it's up to $10,000.
It's actually, you're only allowed to spend a certain amount each day, but we'll get into that level of detail in the meeting. The point is, let's start trying these out and figure out what works.
So we had a group of people who had initially signed up, and we're going to convene the kind of initial meeting for the working group next Wednesday, the 27th at 3 o'clock Eastern. We would love to have anybody else who's interested to join us for that call. And if you are interested, you can just email me at my email address there, and we'll get you on the list.
Great. Good. And nice opportunities here for a lot of us. Shout out to the HPN people who kind of elevated this issue originally, Leah Coldham. Okay, very quickly on FHA Principal Reduction Program. So it's rolling out there. It will be part of the streamlined Fannie and Freddie mods, and essentially they will, instead of doing a forbearance, there'll be a principal reduction on the amount that would normally be the forbearance balloon. So this is important symbolically because it means that we have at least some experience of Fannie and Freddie doing principal reductions, and so it's very, very important on that level. It's actually a fairly limited pool, so it's only eligible to borrowers who are 90 days or more delinquent as of March 1st, so you can't get there. You have already have gotten there. It's only limited to an unpaid principal balance of $250,000 or less, and of course, the LTV is greater than 115%, so they're underwater, substantially underwater. And what happened was that Fannie and Freddie identified 33,000 borrowers who would fit in under that category, and what happens is they send a streamlined modification over to those people, and they expected a take-up rate of that population of about 9.5%. And the idea is, if they can use the principal reduction as an extra incentive to sign up for the modification and get people onto timely payment, then they improve the take-up rate, and they would be making money and doing better than they're doing really well if they got to 15%. And certainly if they got to 20%, they apparently would be doing really, really well. So very high return for them on this issue. And we don't know exactly why people don't jump on these when they're offered, but you can imagine there's a lot of confusion in the marketplace around these things and often not good communication. So it would be greatly in your interest to think about anybody who's got a Fannie or Freddie loan, who's more than 90 days late, has a balance of unpaid balance of less than $250,000, and push them into the system. And the way that this works is that they would ultimately they'll need to accept their streamlined modification. If they accepted it today, they accept it with the forbearance balloon in place, but the forbearance balloon could be forgiven, is my understanding. That's what the text says. So they could either handle it that way, or maybe work with the servicer to be put on hold until the principal reduction gets in place. But the big thing is that they're not expecting a very high take-up rate, and anything we can do to improve on that helps solidify the value of principal reduction, and obviously helps your client a good deal. These balloons will be a real shocker to people when they need to sell, or when their kids inherit the property, that sort of thing. So anything we can do here to improve those numbers, really, really helpful.
And there's just one question, which you may or may not know the answer to, and if you don't, maybe somebody else on will, and they can just type it in. But the question is whether this is available even if the negative equity was mainly caused by a previous capitalization or modification.
Well, I guess I shouldn't freelance on that one. Boy, I would argue that it should be, but as long as it remains a Fannie Freddie loan, I think. But anyways, that's an answerable thing. We'll figure that out. And we could decide to try to get somebody. So Fannie and Freddie are not ready to talk about this yet, but we could in a month try to get somebody in if we felt like there was a large enough constituency for that conversation on this call. So let me know if there's interest in that, and we can try to drill down in those kind of questions with them. Good. Okay, I'm going to jump really forward because we're a little bit behind here. So as you all well know, one of our projects has been to have preferred language, an option in the mortgage process early on, so that home buyers who are not fluent in English can get the correct information, get good communication, and as much as possible. And this would be part of the architecture of how language access would be appropriately dealt with in the mortgage origination and servicing process. So, last we talked, we had learned that we were shut out of including the language preference data field in the URLA redesign. And there's been an aggressive pushback, and we had a great letter, which many of you signed, 126 groups under the Leadership Conference on Human and Civil Rights letterhead, and AFR, Americans for Financial Reform, and us. We now have a Dear Colleague letter that's been circulating in the House by KPAC, by Judy Chu, and a number of other, the Progressive Caucus, a number of others, and we've got, I think, 26 signatures. Is that?
Yeah, right around 30 now, probably.
Okay, so that should go today, we think, or tomorrow at the latest, to Fannie, Freddie, and FHFA. We're still talking with offices about trying to get a similar letter in the Senate. As we go along, we're learning more, and one of the interesting things is that that they're really changing the role of the URLA, and they will no longer require the URLA to be filled out in the beginning, and only that it be completed by closing. And the reason for that is that it's a much longer document than it was, and apparently I'm a little confused about why it is that way, but it's been told to us in no uncertain terms from people deeply involved in the process that the role of that document is going to change. So we haven't backed off on the position that language preference should be built into the URLA, but as others have pointed out, what's critical here is that you have people be able to express their preference and the lender act on it as early in the process as possible, largely before disclosures are put out, so the disclosures come in language, and so the TRID comes in language where it's possible. And so the question is, how do you do that? And you know, we've kind of put that on the table, especially with Fannie, who has, to their credit, been showing them by far the most leadership of the triumvirate we're dealing with, which is Fannie, Freddie, and FHFA. And the nobody's going to reopen TRID. That's pretty much of a political complexity that nobody wants to touch again on the immediate time. So figuring out how the information might be captured is one step. The second one is, how do you then retain that information and have it flow through closing to the servicer? And then how does the servicer capture that information? This turns out to be hugely difficult. And where we thought that the housing counseling data fields would go to the servicer, in fact, they'll go to Fannie and Freddie, who can manage that information, but the servicers don't have data fields that will match that, and it's not clear that they will. There'll be plenty of other, there's apparently not very much information that the servicers collect. Or I should say, servicers is the wrong term here. There's these platforms that very large providers provide. So companies like Black Knight are providing the platforms that many of the servicers use. So we're really struggling with this. We think that the solution is still through the URLA, because that's what the plumbing of the system is, and what's in there is what will get transferred to the servicers will be in the URLA, so we'd like our data field to still be there. We are having very good conversations with people inside Fannie and FHFA, and you know, there's a lot of resistance. It's not like it's a slam dunk, but we're kind of learning in the process. So just to keep you up to date on the latest there, and the latest on what the URLA may look like. So let's move on quickly to our main topic at hand, which is that we, as we all know, HAMP is going away December, end of this year, December 2016, and there's a scramble for what will be in place at that point and what loss mitigations will look like. So as with any situation like this, you can kind of roll with inertia, or you can see if there is an opportunity to create valuable new things or build on existing things to make them work in the best way. We've got two guests today. So we have Julia Gordon, who's now with the National Community Stabilization Trust, and Julia has been a leader in housing issues for a long time, and at Center for Responsible Lending, at Center for American Progress. She was involved with writing parts of Dodd-Frank, and she's now at the National Community Stabilization Trust. She was at FHFA for a while, but you know, valuable and progressive, and also very clear voice in areas that are often not very clear. And so we're happy to have Julia join us to help us think some of this through. And we also have Ellie Pepper from Empire Justice Center, and Ellie's fortunately a familiar voice in our work, and is been both a housing counselor in the field and been working in policy areas. And partly what we're trying to do is really just figure out some of these answers. So welcome, Julia and Ellie.
Thanks so much. Can you guys hear me?
Coming through clearly.
Excellent. So just so everyone knows, we didn't plan this or what we were going to say. So Bruce, do you want to ask questions?
Setting me up. So Ellie, are you there as well?
I am here. Hi, everybody.
Okay, good. Okay, good. So I want to tee it up just a little bit, that's right. We don't have a planned agenda here, but I do want to sort of set out that there's sort of specific things that I think I'm very interested in hearing from counselors or putting in front of counselors so they're aware and can think through and contribute to it. So one of it is this question of what the model should look like going forward, and there's some industry proposals around streamlined and around and we being kind of the America's Financial Reform, and there's been a deep conversation about a more income-based model. It looks more like HAMP Tier 1, and Streamline looks more like HAMP Tier 2. And I think there's also questions about what the level of documentation should be required in either of the systems, and I'd love to hear what counselors think about some of the conversations about that. And then any other things around mechanics that'd be useful for people to, one, know about, or two, get contributions from the field about. So those are my goals.
Well, this is Julia. I'll start by laying out a couple. I think that what we're really doing is answering two core questions, and I'll lay out those questions briefly with some of the various options. I almost think of both of these questions as almost like I imagine lines that you have a little slider, and you can slide the slide along and get halfway or get all the way. I mean, they're not yes or no questions. The first question is how much documentation is required for a mod, and questions, that is a related question to the substance of the mod. But is certainly a question that industry is asking itself, both in terms of baseline application and income verification information, and then verification around specific hardships. So that's one set of questions. The other clearly related set of questions is whether modifications aim for a particular spot in terms of monthly payment reduction, or whether they focus more on being a particular percentage of borrower income. Again, they're not mutually exclusive. If you make something affordable for a borrower with a hardship, clearly you're engaging in some level of payment reduction, and just as clearly if you do reduce payments, you're making something more affordable for a borrower than it might previously have been, but you may not be getting to the percentage of income that we might think of as sustainable over the long term. So the debate is proceeding along both of these dimensions, and just by way of terminology, I'll throw out a couple of things. The HAMP, what we now call HAMP Tier 1, I think is largely being talked about with the language of income-based mod, even though there's obviously more to it than that. There are two other things that get talked about. People talk a lot about streamline mods. To me, that's not really a question on content. That was a question about documentation and delivery, because the industry understands streamlined to be a mod where there is no application, where at 90+ days, the borrower receives a mod offer that is aimed at payment reduction and is unrelated to income or other particular circumstances of the borrower, because there's been no borrower contact to input into the mod. I wanted to mention that because I want to distinguish it from an industry proposal that's floating around out there known as one mod, which I think is often referred to as a streamlined mod kind of incorrectly. But what one mod is more of a, we'll call it a HAMP Tier 2 or GSE standard mod approach of just moving the levers of interest rate, forbearance or forgiveness, and term length to come up with payment reduction, monthly payment reduction. And so keeping those things in mind, where we find ourselves right now is a situation where the government program, HAMP, which, wasn't ever exactly required, but kind of was required, and had an enormous amount of government subsidy in it to make the numbers work, that program's going away. What do we have going forward? And let us assume, I think for the purposes of thinking about it, that it is unlikely that the CFPB, which would be the only agency that could do this across all channels, it's unlikely that the CFPB is going to prescribe a particular mod. They may prescribe some general principles related to fairness and sort of anti-predatory features, but they're probably not going to make some of these decisions with respect to, income-based versus payment reduction or how much documentation. So we're really dealing here with what FHFA will require of Fannie and Freddie, who are the biggest players in the space and who are often followed as a model by other channels. And generally speaking, outside of the Fannie and Freddie or FHA context, what standards might lenders voluntarily adhere to with respect to their portfolio loans that aren't either FHA insured or sold to Fannie and Freddie? I'll stop there. Ellie.
Well, that's a pretty comprehensive description, and I think the only other thing that I would add, for me, what the biggest question that comes into my head about all of this is, do we want to focus more on the largest number of homeowners being offered some type of modification product, or do we want to focus on the largest number of people who can get a sustainable mortgage? And they may not be mutually exclusive, but I also think that it is a question we kind of have to resolve among ourselves about what do we think is more important, getting the most of them out there or ensuring that they're sustainable.
And to put a little more color around that, on kind of those sliding scales I was talking about before, both on the documentation side, the less documentation is required, the easier it is generally for borrowers to complete what they need to complete, and the more servicers are happy because there's less they have to deal with. And both of those two things make mods more likely to happen regardless of how good they are, what the sustainability of them is. Then on the question of income-based versus payment reduction-based, we do know that the more you reduce the payments, the more sustainable a modification is. Obviously it very much depends on the borrower's individual circumstances, whether the borrower is better off with 31% DTI or whether the borrower would be better off with, say, just a 25% payment reduction, and that's going to be different depending on the borrower's circumstances. But it is clear that from the industry's point of view, they view the payment reduction model as the one that's more amenable to lower documentation, which they, in their minds, translate to cheaper and easier. And so that seems to be where there's a lot of interest. And when they do those more cookie cutter mods, they don't need to do individual NPV tests. They do what they call a portfolio level test, which is just basically in the aggregate, are we better off doing these mods or not doing these mods, as opposed to the income-based HAMP Tier 1 like mods, where there would likely have to continue to be a mod by mod NPV, something that's going to get harder to pass both as a result of the HAMP subsidy ending and as a result of the fact that in many markets now home prices are rising, not falling.
So are we getting some questions in here? Are we, Matthew?
Yeah, well, there's been some kind of comments and kind of questions, but a couple. I mean, one person essentially suggesting, I guess it's essentially a streamlined mod, but kind of like a one-time by right modification, which I guess that is essentially a streamlined, right? Where it just kind of automatically happens with a certain amount of documentation. Someone else just asked about, and I think this is referring to interest rate reductions, but she asked, what's the likelihood of getting modifications to be permanent instead of going back up after 5 years? So is that with interest rate reductions? So maybe someone could outline how interest rate reductions would work in the kind of two different proposals. The one mod versus the income.
So I mean, as Julia said, there's a gamut of different models out here, and let me sort of add. We distributed the one mod deck for that Mike Malloy put out from Quicken to the list this morning, so people probably didn't have much chance to look at it, and also the proposal that we're discussing at on the AFR, the Americans for Financial Reform conversations, which is very much an income-driven proposal, and and step up. So 5 years or later, a step up on the rate is one of the ways that it reduces the overall cost of the modifications. So it's a tool that could be used or not used. Interestingly enough, the Treasury people are saying that the fallout for the 5-year step up has not been very high, that they've not gotten a lot of negative experience in the first rung, so where it's jumped 1 point, so there'll be another round coming up. I guess this fall will be the time when we'll start seeing round 2 of those. Though, I mean, I should also point out that Ocwen and many of the NACA loans are life of loan resolutions and don't have the step up, and do not seem to have hurt their ability to do these modifications. And certainly both of them are aggressive modifiers and have a higher modification rate in history, and I know at least on Ocwen that their sustainability has been good. Are there more you want to do? Go ahead.
So someone else, and so these are a lot of the points are kind of getting to the details of the proposals, but someone had said, what about 40 to 50-year terms, which with no prepayment penalties? I think those are features of both the, I don't know if you want to outline how that would work.
So I'm not sure what to call the one that I've been calling streamlined, but Julie doesn't like to have it called streamlined. But the
one mod model.
What's that?
I called it the one mod model.
But that's just the Quicken spin on it too. So anyway, so they rely a lot on 40 years. So I mean, just to add a little bit to
it's tier 2. I mean, it is basically tier 2.
Okay, so yeah, so that also gets, well, okay, so we'll call the equivalent of tier 2. So if we have so 40-year term is really one of the main tools that they use on these, and that of course does reduce the cost, but it's also, you know, how much does somebody own of a house that they've been paying on for some time period, and then to add another 40-year onto that term. And so on the AFR proposal, if you need to use term extension, it goes out to 30 years, so not quite so far. But you know, these are definitely all levers out there that, and the question is, how much of, at the end of the day, to me, one of the issues is how much are people actually going to be homeowners at the end of this, and how motivating will it be to keep their house? So I think people do almost anything they can. So many of the people we see will do almost anything they can, but how much will they be able to recover from, whatever the disaster was that caused their delinquency in the first place? And very frustrated how it becomes more and more difficult for people to maintain any level of equity coming out of these. And I think that's one of the legacies of HAMP, where there wasn't principal reduction, is that there'll be people, a lot of whom are in communities of color, underserved communities, and lower income communities, that will continue not to have any ability to develop equity in their property.
So, Bruce, this is Ellie. I just want to kind of chime in about one thing. So, there has been some conversation regarding the offering of, just an automatic modification at the, whether we call it 1 mod, tier 2, streamline, but that it's it's a lower documentation, straight across the board 20% payment reduction, and that just be automatically put out there and offered to homeowners who are in distress. So there has been some conversation among advocates about, is that like maybe a first step, and that if somebody receives that, similar to what the streamline is right now, a homeowner gets offered that, and then they are allowed the opportunity to apply for something better. So that has been a conversation as well, is that an option, that we provide this kind of tier 2 as the automatic modification that gets put in to keep somebody from going into foreclosure, but that then they are able to potentially apply for something a little bit with a little bit deeper, payment reduction and some other steps in the waterfall required and considered to reduce their payment even further if they so request. And I think that some of the concern about that model, although a really great idea, in many cases that for the streamline process, the way that it's working right now, and it's been working under FHFA, in many cases the servicer offers the GSE streamline, but makes it seem as though that's the only option that the homeowner has, and that if they don't accept it, they won't have an option, and this is their only option, and they won't be considered for anything else. And so there's a concern about that aspect of it too. And so I would just kind of like to hear what other people, out in the field have seen and heard and think about that.
And let me just add sort of what the kind of the proposal, the bigger income-driven proposal would look like, and that is that the first step would be people would go to housing counseling. They would be packaged by the counselor. There'd be a funding stream we would need to set up to pay for the work. And the idea would be so you could address the broader financial issues of the household, not just the mortgage. They would be packaged. They would then provide a complete package to the servicer, and they would be considered first for principal reduction as the first lever, in the same way as the PRA alternative is, the PR alternative. Then they would, arrears would be capitalized. They would be considered for principal reduction. The second step would be an interest rate reduction, and they would have and then the third one would be a term extension out to 30 years if it was needed. And then, but the idea is also that in the waterfall, if people fell out because they couldn't provide all the documentation or for other reasons, they would have the tier 2 equivalent would be the next step on the waterfall, and essentially that kind of automated system, no doc, but you'd get roughly a 20% reduction in your payment. That would be there as sort of the place that people ended up if they couldn't make the others. And so not unlike what the HAMP Tier 1 and Tier 2 can do now. And a couple other innovations there was, and we should talk about this, was some talk about how to reduce the documentation. And the other one is that there be kind of an NPV minimum, so that if in anywhere along the process you crossed your case crossed the line and was no longer NPV positive, you would stop pulling the levers and at least make an offer for that and see if people could make it on that. But if the sustainable, if the streamlined or the tier 2 equivalent is a better deal, then you'd probably want to take that as well. So definitely we could comment on that. Let me just also throw out a very interesting idea. Actually, Bruce Marks put it out there, is why do we ask for income taxes? That, you know, in effect, that's last year's history, and what we're concerned about is what the income is currently. And that it's sometimes, it certainly adds greatly to the amount of paperwork that needs to be reviewed. I think we talked before about wanting to use UBAF or the 710, the Fannie Freddie form, as the intake form, standardized to use for everybody. Add a couple data fields to that. They are discussing adding preferred language to the UBAF right now. So we have to find out if they're going to add the counseling agency. But are there ways to trim back on the documentation as well? So let me stop there.
No one's really weighed in. There's just been a few questions. One comment, someone pointed out that rate reduction wouldn't work for HFA loans because HFA loans can't be reduced because they're bonded. So I guess they're tied to the bond.
State housing finance agencies, yeah.
Someone asked whether counseling would be required. I think that's in the context of what the proposal you were just describing, Bruce, the income-based.
Yeah, so we're saying that would be the first step in the process, yeah.
And someone else asked whether people who had already participated in HAMP, would they be eligible for either of these models?
And I mean, I unfortunately be up to the servicer, but I can't imagine there isn't a way to argue that they wouldn't be. They would be. I mean, Julia, is there any reason that people couldn't have second and third bites at these apples? Julia, you still with me?
Sorry, were you on? I might have had you on mute. Sorry. So, you know, we're making stuff up here. You can give folks as many bites at the apple as you want, but that's so. I mean, what we haven't really talked about here. I don't think it would be that hard if the only part of this conversation we were having is what's the best thing for homeowners. I mean, I think that's challenging because I do think there's a trade-off between ease of getting the mod and the type of mod you get, but we have a third dimension we have to deal with, which is what will the industry actually do here? And honestly, to me, like, I sort of feel like Bruce and others have, you know, Bruce, Ellie, other folks who've been in this conversation have done a pretty good job of nailing down what a good sustainable mod looks like. The problem is I largely suspect that's not actually going to be what we get, and so then you have a tactical question of whether putting forward that type of proposal and pushing it removes you from the conversation about the mod that's probably actually going to happen. And I know I'm sounding right now like I'm throwing the towel in, but I think I'm just largely being realistic. At the moment, my view is it's important for the industry and agencies involved in this decision to hear very strongly from the housing, counseling, and other intermediary communities exactly what they think a high-quality, sustainable mod looks like. So I think going in that direction is a good one. And yes, it does. I mean, there are some channels. This has always been true that there are certain, like for example, on an FHA loan, you can't do principal reduction. That, you know, each channel may have its own limitations, but putting forward an idea of what an ideal or close to ideal mod looks like, I think, is a good idea. In real life, first, we're probably not going to get that, and second, I do have concerns that can probably only be answered by big data, that as we go forward, if there are NPVs embedded in these individual mods, even if it's the sort of, you know, the ideal mod that we've outlined, that lots of people are going to start failing the NPVs. So even if, you know, so if there were a fallback mod, that's where they're going to end up. So I think either way it's important to have a fallback, and I think it's important to understand that there is nothing I have heard either from FHFA or industry that suggests to me that they want to keep a HAMP style mod. The only exception to that is FHA, which we haven't had a really formal conversation with them yet, but they have made noises in the past that seem to suggest FHA HAMP is going to continue.
And I want to comment because this was a big piece of news for me, but we did have a conversation with Mark McCardle from Treasury. One of the things that he pointed out was in relation to the NPV passing, that in many cases the NPV test goes positive on HAMP mortgages because of the subsidies that Treasury is currently providing to the servicers, and those subsidies are going away. And so he was of the mind that a lot more NPV tests would go negative without that subsidy. So just a little bit of a point towards what Julia is talking about.
So are there more questions? Or should
Someone had asked when these would become effective. So I mean, I think the first thing is just to, you know, make clear that these are just kind of proposals at this point, and there's no, you know, none of these are ideas are going to become effective, you know, with certainty at this point. But when is HAMP going to be? When is the end date for HAMP? The end of 2017, correct?
2016.
2016.
So HAMP is over in December this year. So, and there's always the risk there'll be kind of a void here of some going through.
Well, I mean, to be clear, there's not going to be literally a void because everybody has a proprietary mod now. Those will stay in place. But they differ pretty widely.
Sorry, I'm just trying to read through some of the questions and comments. Someone asked, well, basically, who is this proposal going to? Is it going to Treasury? Is it going to servicers? Kind of, who's being lobbied on this issue?
The answer is yes, all of the above.
Yeah, I mean, FHFA is the vehicle that's going to kind of theoretically going to set up the rules of the game for Fannie and Freddie. But CFPB has a role in this, and Treasury has a role, though their role is declining. And interestingly enough, it really appears that CFPB is becoming the greater advocate for affordability and sustainability in this process. FHFA seems to have been more sympathetic to the more streamlined approaches. Treasury, to the extent I know about it, has also been arguing for greater affordability, paying attention to the affordability, sustainability question.
one I think interesting and maybe helpful comment is someone said that most of their clients are getting mods based on their income, but the reality is that the payment is still too high because their incomes are just not enough to even pay the reduced amount. Another, I think, a good question is: do we expect that servicers will agree on any mod, or will they all just do what they want? What's the people's sense of there being kind of widespread industry agreement around any model?
Well, that's what we're trying to figure out. I mean, there are parts of the industry that think it would be good to have some industry agreement. I really don't know what the chances are, but the reason we're in this conversation right now is to try to get some standardization across different organizations.
Great.
So let me just throw out one more shot at this documentation question. So it's been proposed that we argue not to collect the tax returns for the last 2 years. So bank statements, relatively easy to collect. Income documentation, if you're a wage earner, generally not so difficult to collect, a little more complicated if you're self-employed, but a challenge. But is there any thinking in the field about things that could reduce the paperwork? I think using the UBAF form is another way of reducing the paperwork. There's no hardship letter required. But if there are any thoughts about that, we're very interested in them right now.
So while we're giving folks an opportunity to weigh in, I'll just kind of go back to the comment I had made earlier. So the person clarified that the issue has been using gross income rather than net is why payments have been unaffordable.
I'm just going to kind of make another comment about that, because at a local coalition meeting, I was talking a little bit about life after HAMP, and a couple of the advocates around the table argued in the in the other direction, that considering net income when trying to figure out whether somebody's eligible for a modification causes a problem, because it's not seen as enough income. Whereas if gross income was considered, they would be eligible. So it's kind of a double-edged sword there.
Well, which leads me to one of the comments that I think Matt read a couple of minutes ago was somebody said something about how their clients were getting income-based mods but still couldn't afford them. I guess I don't understand that statement.
Well, and that's what they were clarifying, is that I guess the mods the mods they were figuring they were using gross income rather than net, and so they clarified that if they had been using net, the client would have been able to afford it, but because they're using gross. Sorry, go ahead.
But I mean, the question here is this is a question of sort of front end versus back end ratios. Is that the point here? Because I mean, that's going to be essentially your difference between gross and I mean, you know, the 31% may be the wrong number for gross income when you're dealing with lower income people, because their residual income for every other expense in the world is, relatively speaking, higher. And that's why a lot of folks have tried to talk about how to move away from a DTI-based system towards a residual income system. Bruce, the proposal you've been working for still relies very heavily on DTI.
Yeah, what we do is we give people a range of options to use. I mean, give the servicer a range of options to use. So residual income could be one of those models. But we haven't cracked that nut yet, I guess, is the better answer to that question.
That's what I'm saying is the answer. The problem isn't gross versus net. It's, is there a percentage of income that's going to work at all income levels? And my answer to that is no, there isn't.
Yeah, so we said, you know, either have a range of percentages depending on income, or
Right.
use a residual model or use a front and back end ratio. I mean, this is a tough problem about affordability and what the affordability point is, and I have to say I struggled with it without a good answer. So, we left all options on the table on that one.
We also have, I mean, here's something that I think is important to think about, which really goes to a kind of more meta level of trade-offs. One of the reasons that mortgages cost what they do is because when a lender makes a mortgage, if interest rates go up, the lender doesn't make any more money. But if the interest rates go down, lots of people are going to refinance and the lender's going to lose money. That is why back in the day, many lenders like to use prepayment penalties, because it helped protect them from the possible downside of people refining out of their loans. Now that prepayment penalties have largely disappeared, except in the from the bad places, that's being priced into the cost of mortgages. The fact that the lender takes a downside risk. Once mods become something that is more of an as-of-right thing, the lenders are now taking a second kind of downside risk, which is essentially not only are you going to refi out of my loan if interest rates fall, but if you have a hardship, you're just going to suddenly just pay me less and that's going to be okay. So that is going to get priced into the cost of mortgages also. So I think it's important for folks to think about that. I know lots of you work on both the purchase side of these things as well as the loss mit side. So all of this is going to be a little bit of a trade-off. So the more automatic you make mods, the deeper you make mods, the more impact it's going to put on other parts of the system, because lenders aren't going to stay in the business if they can't make what they think is enough money, and they're already feeling, stretched by all the compliance stuff. It doesn't help answer any of the more technical questions we've been asking, but it's just a contextual thought.
Okay, are there more questions in the queue? We're really over time.
Yeah, there's quite a few. I was just going to, the last thing I was going to share is a few people weighed in on the documentation issue and basically agreed with the idea that alternatives to tax returns would certainly simplify the process. UBAS is a lot more user-friendly, and the few comments we got on it were certainly in favor of there being easier documentation.
Okay. Well, thank you very much, everybody. Thank you, Julia. Thank you, Ellie. Conversation to be continued. Next, our next call will have Jim Carr talking about, he's done a whole paper now on, or is in the works on wealth and home ownership and race. Very dynamic, was the head of research for Fannie Mae, was at NCRC, was at CAP for a little while, is now teaching in Michigan, but very deeply insightful. We're kind of privileged to have him. He's set for the 7th of May for our next leaders call. Certainly feel free to email us about any more thoughts about this. As you can tell, we're struggling a lot with these questions and feel like we need to get things moving here because there's running out of time on the big questions. The other big thing is I'd like to make sure everybody's thinking about joining NHRC. We are, as you can tell, deeply involved in lots of the issues that directly affect your work. We're having some of the impact that we've all talked about and really elevated the role of housing counseling and policy circles. still trying to figure out how to do it with the public. And, you know, we do need your support to keep this going, keep us independent. So please put that on your list, too, of things that would really help a lot. But with that note, well, one more thing, Matthew?
Someone just, I had the date wrong on I said that the next call was May 7th. It's Thursday, May 5th.
Oh,
So apologies
there you
for
go.
that.
All right. Okay. Thanks. All right. Excellent. Well, we'll all talk to you in a couple weeks. Great.